All right, good morning, everybody. Just a reminder, just turned on the recording, so I do record our sessions. So everything this morning that we do will be recorded for you to go back and review if you do miss something. If you can just make sure while we're talking that we do have everybody's muted microphone. I have it set up that it does mute everybody, so that everybody is muted when they come on. You'll just have to go down in the lower left where the microphone is. Probably right now has a red line through it to mute you. Video, again, optional. So I won't get jealous if anybody gets breakfast served to them partway through. Okay. But thank you for joining me on this cold, rainy Buffalo day. I guess it is November in Buffalo. So we do have to deal with the weather as it comes through. So couple things administrative wise, like I said in that brief message before, I sent out a couple emails this morning that have some more reference material, some of the stuff that we talked about last week and that we will talk about next week, but some things with example statements for K1s and 1099 INTs and DIVs, how you typically see them when you prepare a tax return when it comes from the client. Also, there was a 1099B example, which we will cover when we talk about capital gains next week. I also sent out a little list I give to everybody that is in my classroom I gave out this week. Had some little chart for those of you in Western New York. It has the school districts for Erie and Niagara County. Those are just kind of a so you don't have to keep hitting F1 in there and go into that. I always put those up for everybody. And also EIN numbers for the schools and daycare, because we're going to be talking about some of those with the non-refundable credits today. Okay. As well, I sent out the answer key for problems in chapters 1 through 5. Okay. So you can take a look at those, even as we're talking today, if you want to take a look at them, and we can kind of have, if there's any questions on them or somebody was unsure. I know one thing we're going to talk about this morning. I had a question come in from one of you that talked about that renter's credit for the one problem in chapter, let me look here. Get so many classes together that it was chapter 4, I believe. Let's take a look here. I'll find that here in a second and see which one that is. But I will look for that so we can kind of talk about that. As we do more things, especially when we do next week with capital gains and retirement, we'll have a lot more discussion about New York State considerations, because there are things that start to come into play with the retirement and such on that. Okay. All right. Anybody remember which one that is? All right, should have been another email that went out. I see somebody says they didn't get the last one. Those just went out at the beginning. Kind of refresh your email and let me know if you got that or not. Like I said, I sent those all out. They're just some materials that are additional there. And if anybody can remember what that problem is, I'm having trouble remembering which one it was. Oh, there it is. It's actually in chapter 5. It's 5.3. It talks about Sarah. Thank you, Joe. It was 5.3 talking about Sarah Day, and we'll talk about that here in a second. Okay. Usually start out the class just asking if anybody had any questions about any of the exercises from 4 and 5 that we have on there. That oops. That. Hold on one second. 4 and 5. 4 was some unearned income, and 5 was refundable credits. Again, unearned income we talked about, you know, with the different things with the interest and such. We'll talk about more unearned income later on, but that's the section that we have in there. We talked about refundable credits. Obviously, the big one on the table is always the earned income credit. I cannot stress enough the importance of that due diligence. I know I had one question come up. They were asking about that due diligence, the 8867 coming up. Make sure on the main info sheet that is a preparer's due diligence. It's not something that somebody would normally see if they prepared their own return. So on the main info, you have to make sure that you do the online and check that box, or excuse me, e-file, that you do that, and that you also make sure you complete your preparer information at the bottom. Okay? All right. Let me see if I can get, we'll do a quick section on that, and while everybody's getting things together, I'll bring up that problem for Sarah Day. And we'll see if we can find that one. Actually, it's not in there. Just getting the screen set up here, and then I'll share with you guys so that we can see that, and we'll talk about how that works. Okay, so let me share the screen here. I don't have the day return, but I do have my friend Charlie Brown up. Okay, so once I have Charlie Brown up there, on the New York, the IT 201 form, if you go to page 4, there is a credit on line 67 that says real property tax credit. Okay. What this is this is a credit for renters, and there's a little form in here for the real property tax credit called the New York 214, and what that is basically renters, they're giving them a credit that they may qualify for because basically part of their rent helps the landlord or the owner of the property pay the property tax. Okay, so we go on to that form. And once we're in there, we have to determine if we're eligible. You'll see the red there that has the problem there that says, did you occupy the same residence for the last 6 months? We know from Sarah that she moved in there in January, so that is a yes. Did you own real property with a current market value of more than $85,000? We're going to say no. Sarah did not own anything on that nature. It was not public housing, and it was not a nursing home. Okay, so that would get her the ability to be able to possibly have this credit. Okay, on the tree on the left, if you take a look down there, there's a page 2 for the New York. I kind of lit it up down there on the tree on the left, and we're going to compute in part 4 to see if Charlie Brown would qualify. Okay, on this part, we have to compute how much she paid in rent. A little shortcut, if you hit F5, little calculator pops up. I know that she paid $430 a month times 12 months, and if I hit enter, it populates that for me. So that's a little shortcut. I know I'd sent out on the keyboard shortcuts, but that's the way that one works. Okay, does not say that anything for what she had, that she pays any of the rent or anything like that. So we're just going to say none of the above. This would be for Sarah. And then down here, we would put in 12 for the number of months that she would have occupied because she moved in there in January. Now, based on this and Charlie Brown's income, his income is too high, so he does not qualify. If I take, I got a lot of things going on here with Charlie Brown. And let's see, he must have some retirement income. Okay. Okay, and where is the rest of his income coming from? Trying to get his income low enough here so you can see it. Oh, he's got a whole bunch of interest. Okay, so we have, oops, he has some Social Security. We gotta get rid of the Social Security. Okay. And we're gonna put just a little bit of, for Charlie Brown and his wife. A little bit of income in there. Okay. Now, if we take a look, his income with it being $15,000, you can see the calculation of the renter's credit, okay, and that they would be eligible for it, okay, and you can see that it's a smaller credit for low income. So Part 5 on that New York 214 page 3 has the $137, and this is on New York a refundable credit. So they would get that credit no matter whether they had a tax bill or not, okay? So that's the way that you put that one in. It's kind of hidden there with line 67 being the real property tax credit. So it's kind of one that kind of hides in the there. So yeah, you do this one, Pat, you would do this one. But again, income has to be pretty low, okay? It's one of those credits that has a very low income phase out threshold on New York. You know, if I take the income for the two of them, okay, and I put it up at 40,000. Okay, you can see that they don't qualify for it. Okay, so then all of a sudden the credit's off the table. All right, okay, because it says on line 16, household gross income if more than 18,000. Stop here, you do not qualify. Okay, so it is a very low threshold to get that that renter's credit. Okay, but it is a nice credit to find. If you have a household with less than 18,000 and they're paying some rent, it is a nice one that they can put in there, and you know, $100 is $100. Okay, it's always something that you want to ask and put in there for them. Okay. All right. Okay. Is there any questions on any of the exercises from chapter 4 or 5? You can come on. If anybody wants to speak, you can unclick your microphone and go ahead and speak on that, or you can type it in the chat, whatever you'd like to do. Chapters 4, a lot of those just had to do with interest, income, the hand exercises, making sure you understood how the forms work to get it from the Schedule B onto the 1040. Okay. Realize again, it's kind of a contradiction, and I know I talked about it when we talked about the unearned income. On a tax return, interest and dividends go on the Schedule B. But I cannot stress enough to make sure that when you're in the TaxWise software that you do the worksheet inside the B. So contradiction, it goes on the B, but it does not go on the B for software. We go to that worksheet. I'll make sure that a couple of the problems that we do at the end today that make sure that they have some interest and kind of show you on those. I emphasize that you make sure that excuse me one second here. I emphasize that you make sure you realize if it is taxable on the state, that state adjustment. And then, like I said, those sheets that I showed, and I did email those out, that you make sure you understand on the muni bonds, they could be exempt on a state side, but they're only fully exempt the whole amount if it's based in New York State. Some muni bonds may have multiple states, some have all 50. And I gave you an example of a little sheet from Fidelity that shows some of its municipal bond funds, and to make sure that you take a look at that. Like the first column, I believe it was like 6.71% or something that we had on there. Okay. All right. Okay, so any questions? Let's see. Pat had trouble with New York State tax refund worksheet needing prior tax year data. Yeah, that worksheet that's there, Pat, we'll talk about that again a little bit more on some of the refunds that we do on the problems. The worksheet is not real good if you're not a returning client or have the prior year's return information. Does generate a lot of red and does ask you for a lot of different numbers. Sometimes it's best, and this is probably the only time I will ever give you permission to use this button. Otherwise, I will reach through your computer and take this button away from you. But this is your F8 button to override, okay? So this is the only time I ever give you permission to do that, because I know once you check yes in that middle box. So basically what I'm talking about, let me show you on a return here. We'll go back to our friend Charlie Brown. And what Pat's referring to is if you do itemize and you get over here, and sometimes when you hit this box and you try to type in, say they had a $500, you can get it in there, okay? If you can't, you're going to be able to hit F8 and override it. The worksheet that she's referring to, there's a state tax refund worksheet that is embedded inside of here that when you hit F9, you can go to it. And it does need a lot of the previous information. Talks about things from 2016 return. We're in 2017 with some things about things on their Schedule A, some things about filing status, their taxable income, stuff like that. So again, I much rather have you do this one as far as knowing the rule. You know, if we have somebody that has a $1,000 refund and they have 2 children where they got the child tax credit on New York, they subtract out that $660, $330 per child, and so you just put that $340 on there. If it doesn't allow you to put it in there, again, we can hit F8 here and put that $340 in there. It will appear like that, kind of gray. That's the override. But again, this is the only time I give you permission to override, okay? Otherwise, I will log in remotely to your computer and take your F8 key away from you, okay? So do not be using this any other spots, all right? Okay, so that was my dad's speech for the day. Just like I had one last time about the earned income credit and due diligence, that's my dad's speech on that, okay? All right, any other questions about anything from Chapter 5? We had those refundable credits, and again, okay, what do we got? Problem 5.1, what do you do with the Empire State credit? Okay, let me get 5.1 here. Hold on one second. Okay, so on 5.1, if you have your workbook, this is the one for Jeff and Lisa Harmon. This was one where Jeff and Lisa filed a 1040 last year. As soon as we hear that or talk to them about that, we know that they were able to itemize, okay? They did itemize. They received $1,066 from their state refund last year, which includes an Empire Child credit of $660. They would like to file a joint return. So again, this is a case where that $1,066 was their state refund because they had that Empire Child credit. You subtract that $660. And then the balance there, which is what, what do we got? $406, I believe. would be the credit on that, okay? So we take that 166, subtract that 660, and we got that 406 is what actually goes in there for them, okay? So that's the way that we do that one, all right? So that was kind of that example that I was talking about that has it on there that, you know, you back out those credits, the child tax credit or the Empire credit. That's what that child tax credit is on the state side, okay? And again, from 5, the big thing I want you to take away, deductions, okay? They are going to lower our taxable income. Credits are going to eat up our tax bill, okay? Non-refundable credits stop once the tax bill's gone. Refundable credits, Energizer Bunny, keep going on and on and on, okay? And again, we're going to talk a little bit more about the American Opportunity Credit because we're going to do some of the education credits in today's. All right. Okay. Any other questions from chapter 4 or 5? Again, the exercises, the quiz, the problems. And again, you know, don't hesitate to pop on your microphone and ask. Like I said at the first outset, I want to make sure that everybody feels like this as much as a classroom as anything. And I try to make sure that I get my students that are in the classroom to engage in stuff and have things. So that's what I want you to feel like you guys can do here too. Okay. All right. And while everybody's thinking about that, I can't remember if whoops, we got one. Let's see, 5B. Okay, on page 6-8. All right. Oops, 5B on. Is that question 5B on 5-8, Deborah? Okay. All right, so let's see here. So 5B, 6-8 would be chapter 6-8. Is that chapter or question 6, exercise 6B? Or is that question or exercise 5B? Exercise, is it the one from chapter 5, I would guess, 5B? Let's go find 5B. Okay, 5B. And which one on 5B there, Deborah? Well, let's just go through 5B here real quick, okay? This is a good one because it talks about earned income credit. First one, we had James and Mary live together. Question 6 through 8, right? Okay, gotcha. Now I'm tracking. All right. So in 6, we had Sandy, who is 4, is the daughter of Jim Jones, 27, and Shirley, I guess that's pronounced Brosh, 28, who lived together all year. The couple is not married. Jim's AGI is 24,000, and Shirley's income is 15. Shirley and Jim cannot agree on who should take the child. They want the IRS to make that decision. Is Shirley allowed to take the credit? Okay. All right. What's one of our tiebreakers? And, you know, when we understand what the earned income credit is and its due diligence, if they cannot agree, the IRS is going to break the tie, and that tie is going to be broken by the highest AGI. And in this problem, since they're not married, Jim's AGI is 24 and Shirley's income is 15. So she would not, if the IRS has to make the decision, she would not be allowed to take the credit because her AGI is lower. Okay. Number 7, Jim and Fran Bates were divorced in May of 2017. They have one son, Jared. Jim was granted a divorce decree stating that he can use Jared as a dependent on his tax return. Jared has lived with his mother since May. Jim's AGI was 24 and Fran's was 12. Jim would like to use Jared for EIC purposes. Is he available to take the credit? Okay. Again, remember our test. In this case, Jim is not the custodial parent. All right, as it says in the divorce decree that he can use him as a dependent on his return, but he cannot use him for EIC since he lives with his mother. She is the custodial parent, so that's where the EIC would go. She can release the child tax credit and or the exemption to Jim, but she cannot release the EIC to him. That follows the child where that child lives. Okay. One of the problems we'll talk about, there's a way that you can put, in this case, you would do a filing with Fran as head of household with Jared on the return and still be able to qualify for the EIC, but you would be able to release the credit. And I'll make a note here to make sure I talk about that, how that works when we do one of the problems in the software so you can kind of see that. Okay. Okay. All right. Okay. We have 7 using the problem 7. Could Fran claim Jared for EIC purposes? Kind of just went through that one. Yes, she can. Okay. She can claim them. All right. Okay. So we have that. All right. Okay. Let's go down here. We had some other things that were in there in the chat. Let's see here. Not Hemingway. I think that's, who is not Hemingway? Is that Jim? I think that's Jim. Well, anyway, Mr. Hemingway. Can Sarah use W-2 with old address? Yes. What we have to do on there, as best as we can, is recreate the W-2s within the software so it's as accurate as possible. Okay? So that's where we have to make sure that we look at those addresses. When we do recreate it, if it's the case that the address is different, we would have to change that. So if I go back to my friend Charlie Brown here, and I look at the W-2, okay, and in this case it matches what's on the header of the return, but if he had moved and they sent his old W-2 to this address, he lived at 123, we'll say Snoopy's house, okay? All right. Okay, so we would do that. Doing that, whoops, make sure you're in all caps, sorry. Doing that on here does not change anything on the return, okay? So it doesn't change anything here. This is the address on that main info, and what shows up on the 1040 page 1, that has to be their accurate current address, okay? Jeff Harmon needs a W-2 fix. All right, let's see, where's Jeff? Has a W-2. And he has on there a W-2 fix in regard to, which part was the fix that you needed there, Jeff, or Joe, for Jeff? Mm-hmm. Yep. So on there it shows that North Davis Street. Yep. And they put in David Street. Might have been a typo. Might have been that. So yes, you would want to correct that. Okay. All right. Okay. All right. Any other questions out of chapter 5? Just kind of looking over them myself here, 4 and 5. Nothing really on the quiz. I'm trying to remember some of the ones that came up in the Again, you know, doing those sheets, those longhand sheets, I know it seems, you know, when you're thinking that you go in the software and it works much better, still doing those exercises with the sheets is so important because you understand how the credit is calculated. And a lot of times, like I told my students this past week, it's great to do these forms and look at them because you see how some of the phase outs work and some of the calculations there and the limitations, especially when we're doing these next 2 chapters on non-refundable credits. Okay. Any questions on the quiz in chapter 5? One I know that everybody always kind of forgets about was that question that talked about the fact that earned income credit, you must be at least 25 and under 65. A lot of grandparents forget that when they have the grandkids and they reach 65 that they're no longer eligible for the EIC. Remember the age thresholds that I talked about. First one is 13 that we talked about for the, that we'll talk about with the dependent care. The next threshold is 17. When they turn 17 in a tax year, they lose the child tax credit. Next one is EIC. First hurdle is 19. Second hurdle is 24 if they're a student. There is no age limitation if that child is totally and permanently disabled. Okay? So those are kind of some ages that come into play with kids on the tax return that you want to kind of remember. And a lot of times people will get confused between that 17 for the child tax credit and those ages for the EIC with the 19 and 24. Okay? All right. Let's see here. Trying to remember if there was any other ones that were good in the. Again, don't get too hung up right now on any of the healthcare credits. That one will come into play when we do chapter 16 about healthcare, where it's the Affordable Care Act and that subsidy and credit. All right. That healthcare tax credit is just, have to remember, is for either a displaced worker that lost their job or somebody that, I always use the example of Delphi up in Lockport when they had the bailout. Okay. All right. And what was age 13? Age 13 is the child or dependent care, like daycare credit. Okay. We're going to talk about that today because that's a non-refundable credit because we're going to do both chapters on non-refundable. So we'll hit that today. Okay. Any other questions on chapter 5? Okay. And like I said, you know, with recording today, remember that there are recordings of just the chapters from the classroom sessions because we're meeting twice a week and those are 3-hour sessions. You know, I have where there's just chapters, you know, on the online here because of our time constraints. I mainly just hit the major points that are what 95% or more of the returns are what you see and things that happen. I do sometimes talk a little bit more about other things. You know, sometimes in the classroom, I'll get off on a tangent and bring something else up, okay? The other thing wanted to bring up too, like I said, I sent out the stuff about 2018. I'm trying to interject best I can with things about 2018 tax law. If you really like to look at tax forms, if you go to the IRS website and you type in the search or even in your Google, you type in IRS drafts, it'll take you to all the forms that they're starting to bring up here for the 1040 for 2018. So you can kind of see how things work a little bit different, all right? If you take a look, here is your infamous postcard. That is the front of your postcard. That is the back of your postcard. Okay? So that is the postcard tax return that you've heard so much about. Now, I being probably more sarcastic than I sometimes should be in situations, this postcard is great, but as you know, the best way to file a tax return is an e-file, okay? I don't know that there's a difference electronically between sending in a piece of paper and a postcard. It is my understanding, and I double-checked with my IT, that there's no difference, all right? Really what it's done is, and I know it's hard to read in here, there are schedules 1 through, let me check my notes here, because I printed some of them out. There are schedules 1 through 6. So basically we've just added a layer, okay? And best example is you will have a separate postcard. Let me get here. So the next 2 chapters, we're going to cover the postcard that deals with non-refundable credits, okay? So that is that postcard. As you can see, a lot of blank paper there, all right? So basically what they've done is, if you're into arts and crafts, basically what they've done is they've taken the 1040, cut the pieces apart, and pasted them on another piece of paper. All right. So again, you know, we'll kind of try to talk as much as we can as we get more and more information. Hopefully before the end of class, we'll have that first draft of the software so I can show you some things there to see how the forms work. But basically what they did is they added a layer to the returns for the different schedules. Okay. All right. Okay. And again, if you want to look at some of these and see what's coming down the pipeline for 18 versus what you're learning in 17. And again, you're still going to have to know 17 because there are a lot of things that carried forward into 18. Tax forms may work a little bit different, but a lot of the things are very much the same. There are a few things that have changed. A lot of it just has to do with the amounts or the thresholds, but it's basically the same law, but with some tweaks to it, okay? So those are where things would come into play. All right. Okay. All right, so we're going to head into Chapter 6, all right? As I said with Chapter 5 and the refundable credits, those are your Energizer bunnies. And if I did not give a shout out to Tiffany Fabian many moons ago when I took the class with her, that's the way that she taught it, and it's stuck with me, and I've always used it. So refundable credits, Energizer bunny, they go on and on and on and on and on, okay? Non-refundable credits, those are Pac-Man credits, okay? And again, I'm probably dating myself. At least I didn't make a reference to Pong. But the non-refundable credits, those are Pac-Man. Remember Pac-Man eats up the little dots, and once the dots are gone, it's done. So that's why they're the Pac-Man. They just eat up that tax bill. Once the tax bill's gone, we stop, okay? And we'll see how that works. There are some credits that we're going to talk about today that have carry forward, okay? I don't want them to be confused with refundable credits, but these are non-refundable credits that if you don't use the entire amount in the current tax year, you may be able to carry forward, okay? All right, so we're going to start out here in Chapter 6, and as it says, our objectives here, we're going to learn about the foreign tax credit. Again, I referenced that forms that I sent you, the investment brokerage one where I blacked out some things that I sent to you. Foreign tax credits show up in there most often because somebody has holdings in their investment or brokerage account that has foreign tax credit. We'll talk about how to do that. We're going to talk about the child and dependent care. Again, this is not just the daycare credit. It may be the case that there's an adult, you have mom living with you, dad has passed, she's unable to take care of herself, maybe dementia or whatever, and she's in an adult daycare. That's a credit you can claim if you have that individual on your return. So it is a dependent care credit, okay? And then we're going to talk about a big one for all those that have college kids, the American Opportunity and the Lifetime Learning Credit, okay? American Opportunity we already talked about a little bit because it has a refundable portion, but we're going to talk about mainly this is how we do choosing between the American Opportunity and the Lifetime Learning. Between those two, we're going to bring this kind of full circle with the education credit, okay? All right, foreign tax credit, okay? Basically what this is, for most of you and most returns, again, this is for investments that may have a foreign tax holding. Now, there are instances where we do have people living here that have foreign income, okay? And we may be able to give them a credit for that. You have to be, this one you're not going to see a lot of as far as the foreign income. We do have somebody in our office that does Canadian returns where they have this foreign tax credit because they may be a U.S. citizen living in Canada or living abroad or whatever, and they may need this credit. But most of the time, there is an income exclusion that you don't need this credit because you don't have a tax bill in the United States. But if you do, and you pay taxes in another country, based on what shows up on your tax return from that country, you can get this credit to offset your possible tax bill. And like I said, most of the time, you pay a tax in a foreign country that would wipe out any income tax from the earned income that you have, okay? Again, when we get into the problems, I'll show you a little bit about that. I'm just making a note to myself so we can talk about that a little bit in there, okay? Because we'll show you what that is, all right? So you can read through here. Again, you just don't see a lot of these. Most of what you see just comes from investments, and it's a very simple method to put in there, okay? As the health box says there, taxpayers sometimes have foreign income that comes from foreign interest and dividends. It'll show up on their little INT or the dividend statement, okay? And we'll put that in there. This form 1116, you're not required to put that in there and not required to use it. But again, when we get into the problems that we're going to do for Chapter 6, I'll show you how that form works should you need to do it. But I'll also show you how it works if it's just for investments, okay? Child independent care credit, okay? This is a good one. However, I cannot stress enough that it is a non-refundable credit, okay? As it says there, care of a dependent who is under age 13 or for a spouse or dependent who is not able to care for him or herself. This is a credit a lot of times that people will come in and they'll have this, and I have grandkids myself now, and my kids they're getting to the age for daycare. And for what they're paying for daycare, it should be called the preschool college credit because of the amount of cost to child care now. But this is not a credit when they come in that is a dollar for dollar credit for every dollar that they spend for child or dependent care. A lot of times people have this image that some of these credits like this are a way for them to wipe out their taxes and get a deduction. It is not a deduction, it is a credit, okay? And as it says there, the credit can be up to 35% of those expenses depending on gross income. So what I'm saying is, you come in with $10,000, we may have it knocked down to $3,500 that we're going to use for our calculation, and that may be further knocked down depending on what your income is, okay? So it is not a dollar for dollar credit. It is not a deduction. So I can't emphasize that enough because sometimes people will not understand how they did not get is huge credit for all this money that they're spending for childcare so that they can work, okay? All right. The other thing for dependent care is be very conscious when you're putting in the main info. It's a great spot to ask. There's those little columns, and again, we'll talk about that when we do a dependent care. But once you see there's a child under 13 and they maybe have W-2 income, is to ask them, is the child independent care? Or are they in an after-school program for the Y so that you can work and you can pick them up at 5 o'clock, okay? That way, sometimes they do not remember to bring this in, and it's a way for while you're working on the return to ask them, and they can try to pull up or get that information, okay? The other thing is, some employers will give people pre-tax dollars or flexible spending accounts towards their child care. Again, box 10 on the W-2, make sure that if you see that, light should go off. That must be used for dependent care. So we'll have to make sure, because that's another way that then on the tax return, that credit may be reduced. Okay. All right, here's some tests to claim the credit. Must be care for one or more qualifying persons. And again, it says persons because it's not just necessarily a child. All right. The taxpayer or spouse must have earned income for the year. Okay. Again, it's a credit that if somebody's out on unemployment, they may not get. The expenses covered must be paid so the taxpayer can work or look for work. Okay. Again, if they're looking for work and they have some small earned income, they could get this. All right. The payments must be made to someone the taxpayer cannot claim as a dependent. So for all of you that did not realize this credit existed, it does not mean that an older sibling of one of your child's can go on your return as a credit for babysitting. Okay? That does not work. All right? The taxpayers must file single head of household qualifying widower with the dependent. If married, you must do married filing joint. All right? Unless there's an exception to the rule there. All right? And the care provider must be identified on the return. All right? You cannot put in the old lady that lives next door. Okay? All right? If, I'll show you on the return, if she is apprehensive about giving you her social security number because of identity purposes, you still have to disclose that you paid her. Because why? If you're going to take the credit, the IRS is looking for the other side of the equation and they want to know who you paid it to because that's income and they need to pay tax on it. Okay? So make sure that that's the case. All right? Talks about the qualifying person test that we talked about, the earned income test, work-related, payments to relatives, filing status, and joint return. Again, just a little bit more of an explanation of those lines that we went through. All right? I can't stress enough, I love the little charts from the IRS, especially when I was starting out doing tax returns, because it gave me my script, if you will, for asking those questions when I had to interview somebody doing their tax return, because it gave me the thought process that I needed to ask. So I can say, was the care for one or more qualifying persons? Yes. Do you have earned income? Yes. Did you pay the expenses to allow you to work? Yes. Were the payments made to someone your spouse or you or your spouse could claim as a dependent? No. Were the payments made for your spouse, the present qualifying person who's a qualifying child under age 13? Okay? No. All right, so you can see that as soon as I get to maybe a point that all of a sudden if I said the wrong answer, my arrow goes down, you cannot take this credit. Okay? So it kind of learns you the thought process. When you're asking somebody about the dependent care, saves you a bunch of work, because then you're not in there filling out the form and then going, I wonder why the credit didn't show up. Okay? So there are some things that those flow charts. I realize they're kind of confusing, the arrows and the boxes and stuff like that. Looks like if anybody's an electrical engineer, looks like for something to program a cell phone or something. So, all right. We talked about provider identification test. If it's to a church that does not have an EIN number, you can put in there tax exempt, okay? And you got to try everything you can. That's why I sent that list out with a bunch of the EIN numbers that we see most often for some of the daycare facilities, all right? As it says, this requirement means the lady next door must report this income in order for the taxpayer to claim the credit. And I will show you how to do that, okay? You can get information from them. There's a little form, a W-10, that you can do that to obtain their information, okay? As it says here, the care of a qualifying person must be for their well-being and protection, okay? Preschool qualifies, so does after school and before school, and summer school and tutoring programs do not. Neither does soccer, football, ballet, gymnastics, or anything else like that, okay? I understand that may be for their well-being as far as their exercise, and it may be so that you can work, but again, has to be, and there must be there for their care, for not for food, lodging, clothing, education, or entertainment. Okay? Talked about the dollar limit. You know, even on my example where we spent $10,000 and then we had 35% for $3,500, that's even knocked down to $3,000 for one person. Okay? If there's 2 people, it could be $6,000. But if there's 5, the credit starts at 6,000, and then we see what portion that we get of that. Okay? All right. There'll be some exercise in here again for you to kind of determine if they are eligible to take the credit. All right. As far as claiming the credits, we're going to do it on the form 2441 that will light up on your tree when you check that column in the DC after the person's name on the main info. Okay. All right. We'll see a lot of the rest of this kind of in action when we get into the problems, so I can kind of show you on those with the calculations and how that part works. All right. Again, I can't stress enough, make sure you're conscious if there is in box 10 on that W-2 where they're getting pre-tax dollars towards their dependent care, that you need to make sure that you take that into account and don't give them credit for all of the dependent or child care that they paid. Here's the amount of the credit. You can see 35%. Again, it was based on income. As our income increases, we max out at 20%. Okay, and it goes through some examples here where that credit can be really reduced. Okay, all right, and actually it shows on here on this problem. This is the 2441. We see that the taxpayer had Susie Smith in dependent care at Little Red Riding Hood. They paid, according to the statement from Little Red Riding Hood, $3,900 excuse me, towards their dependent care. However, if you notice here, the expenses, which are qualified expenses, were $2,900. Okay? Now, if you look at page 2 of this, you can see that it shows up that they had $1,000 of dependent care. Okay? So their credit, instead on line 3 reading 3,000, it reads 2,000 because we had to reduce that by $1,000 before we did the calculation of their credit. Okay? That being said, we put the 24,000 in there, got down, 343 is the credit. So again, we're talking about $3,900. It's not a dollar for dollar deduction. It is a credit. So the credit is $343. Okay? All right. Okay. We'll touch on this one just for a second here because it kind of segues in, but there's a Schedule H that you would do. This comes up a lot more often now than it used to, just because of the cost of nursing homes and assisted living areas. Some people are being hired to be household employees. So if you're paying somebody in that way, you have to basically on your tax return complete a Schedule H that would report all of the payroll taxes that you would pay. Okay? See it a little bit. Again, just be aware of it if you want to go look at the Schedule H and see how it works. It almost looks like what the quarterly payroll tax forms are that somebody would turn in if they had employees for their business. Okay. Our friends, the Boyds, are there. They're back, Tim and Michelle. Okay. And there's some exercises for you there to complete the 2441 based on their information for their child care. Okay. All right. Education tax credits. These are a big one. Okay. They're also one that gets a lot of scrutiny from the IRS because they want to make sure, that these credits are given properly. Okay. Great little table here because you have to be able to distinguish between the American Opportunity Credit and the Lifetime Learning Credit. Okay. As we talked about, American Opportunity has a refundable portion. The Lifetime Learning does not. Okay. And I cannot stress enough that you have to understand the American Opportunity is $2,500 per student. Okay. The $2,000 credit is per return. All right. So even if you have 2 dependents that have started grad school that you can keep on your return, you can only get a $2,000 credit per that return. You don't get it per grad student. Or, if we'll see in one of the problems, both husband and wife are going into grad school to work on their MBA, again, lifetime learning, okay? The American Opportunity, as you see there, it talks about the phase outs, the modified adjusted gross income, pretty high, 180,000. For lifetime learning, it's 132,000. As I talked about, American Opportunity has 40% refundable or $1,000. None of the lifetime learning is refundable. It's a true Pac-Man credit. American Opportunity is only available for the first 4 years of post-secondary education. Lifetime learning, no limit. Okay? All right, so that's the 4 years. The type of program required, the student must be pursuing a program leading to a degree. And on the other one, the lifetime learning, student does not need to be pursuing a program leading to a degree. Okay? Must be at least a half-time student. Lifetime learning, you can just take one class. American Opportunity, we have the felony drug conviction. And this actually comes up on the FAFSA for people that have done that for their students. You have to answer the question, has the student been convicted for the felony possession or distribution of a controlled substance? All right? I guess with the lifetime learning credit, they really don't care what you do. All right? So they don't worry about those felony drug convictions if you're doing the lifetime learning. Qualified expenses, pretty much the same between the two. We've talked about that. You have to really be able to scrutinize on that because a lot of times the 1098-T that we see has the tuition on it, but there may be extra expenses for things that they need to be able to complete their course of study. Again, I always use the example, going back to my friend Charlie Brown. He went to school to be a cartoonist, and if he's required to get a certain set of paints and pencils and drawing pads and stuff, those would be course materials. If somebody's going to school to be a computer programmer and they have to have a specific computer to be able to do the homework, that may be. Obviously, books can be added in there too, okay? Talks about payments, talks about tax ID number, and talks about the EIN number for the institution. Again, on those sheets that I sent out, I did put some of those in there for you so that you have some of those, because sometimes people will not have that information. If they have a 1098-T, they will have it. If they come in with something that's maybe just a statement from the school or print off the student portal as far as the billing, it might not be on there, so you can have that sheet to look it up. Okay. All right, so we have everything there. Talks about claiming an education credit. It's for education expenses paid for himself, their spouse, or their dependent to enroll or attend a college-eligible educational institution. And again, you'd be surprised on these, the number of different things that do qualify for this. A lot of times people are surprised and sometimes they're apprehensive to ask, but some of the cosmetology schools in the area are qualified educational institutions. They have components of their curriculum that is not only for cutting and coloring hair or whatever, but also have business things so that they learn the bookkeeping and they learn the sales tax and things. So they can make that as a educational institution, and they will have a 1098-T from there. Okay. One thing too is for the education credits, you can take the credit if grandma or grandpa are feeling very generous and they have decided to pay juniors tuition. Okay, that is a third party, and that third party can pay that. The third party does not get the credit. The credit follows the dependent. What I mean by that is if junior is on your tax return and they pay the tuition, you can consider that paid by somebody on the tax return because it follows the dependent. The other one too is expenses that are paid by loans, okay? Those loans, like student loans, are considered to be paid in that year. I realize that you're going to be paying it back, but it does count. Scholarships do not count, okay? So they do not count on this, all right? We went through a lot of this with the American Opportunity before, okay? Qualifying education expenses, it talks about that. I stress that it does not include meals, room and board, athletic fees, insurance, transportation, and other expenses unrelated to the student's academic course of instruction. Okay? Anymore with a lot of schools, I know that with my son, my middle son, in school, I could not wait to get him out of the dorms once he was eligible and into an apartment, because what I was paying for room and board, I felt that they should have put my name on the outside of the building because I was paying the mortgage. Okay? Tuition, room and board is not deductible. As much as everybody would like to, it is not. Okay? All right? And it can be paid, doesn't matter, cash, check, credit card. Again, borrowed funds, does not matter how that is paid. Okay? Have questions come up every once in a while about the 529 plans. I'll kind of show you how those work. That's a New York State consideration for people that do that. So, you know, paying that money into a 529 and then paying the tuition, it's much easier to show you that. There's not really a lot of addressed here, but to show you that when we're in a problem. So I'll make sure that we talk about 529s because those are very popular now. Okay? And again, tax-free educational assistance, we're talking about scholarships, okay? Those are not anything that we can use for the credit, okay? You know, so that's where we have to make sure on that. Now, reminder, we talked a little bit about it, that if there is excess scholarship income that is not used towards any education expenses, that can be declared as income and would show up on line 7 on the 1040. Okay? All right. As it says here, no double dipping. All right. As I tell my classes, my students in the classroom at the end of each year, and I'll probably do it for my online as I'm reviewing your problems that you're sending in, I do give out the golden ice cream scoop. For those that double dip and see that they have. There's always those individuals that try to make sure they can get as much as they can on the tax return, but this is a best example. You cannot take the American Opportunity and or the Lifetime Learning together, okay? They would qualify for one or the other. When we do adjustments to income, we'll talk about the tuition and fees deduction. It is another option, but right now we're just worried about these non-refundable credits, okay? As I talked about, expenses that don't qualify. Another big one is, and I always, since I do health insurance and Medicare for individuals, this is one I always help the parents and or the kids with. UB charges you $2,200 a semester for a child's medical insurance. There's a waiver that they can fill out if they're still on mom and dad's or have their own insurance so that they get a credit back on that. But that is automatically billed at UB for each student, and they have to ask for a refund on it, okay? So insurance is not, and you know, for those of you that have kids in the SUNY system, you're going to want to take a look and make sure you didn't pay twice for insurance and have double coverage, because you have to fill the waiver out. It is automatically billed, okay? Again, sports, games, hobbies, and non-credit courses, nothing that we can do there, okay? So if they've decided to take Frisbee golf as one of their electives, the purchase of a new pair of tennis shoes and a Frisbee do not count, okay? These are qualified education expenses. All right, so it'll go through some exercises here that you'll work on that kind of talk about different things. If anybody did any of these and they got questions about them, let me know, okay? We can kind of address those as we go along. All right. And then it kind of gets repetitive here. We talk about the American Opportunity Credit, who can claim it, how it works, that they must be, you know, in their first 4 years, they got to be enrolled at least half-time. Again, it goes through all those. The old credit, as it says down here, was the HOPE credit. That was what it was called before 2009 and before it became the American Opportunity Credit. So we got to make sure that we understand 4 years is all they can use that. The odd thing that comes into play is a freshman will go to college in the fall of a tax year. And a lot of times the spring of the next year is billed into that fall, okay? So that's the beginning of their 4 years. Now, in the year that they graduate, it actually becomes the 5th tax year, okay? You do not get to take the American Opportunity because more than likely that tuition for their last semester, because they graduate in May, has been rolled into the previous tax year, okay? If you do have expenses in that 5th year or the year that they would graduate if they're on a 4-year plan, you get to take that as a lifetime learning. You do not get the American Opportunity. And again, the IRS pays very close attention to this, okay? Little thing in there too that talks about students that withdraw from classes. You can claim the American Opportunity Credit for qualified education expenses not refunded when a student withdraws. So it may be the case, sometimes I've seen where we've had to amend returns because, you know, we took a credit, then the student withdrew, and that credit was actually returned as a portion because some of the tuition was returned. So you have to make sure that you pay close attention to that, okay? Half-time student again. I think I've told the story, but I will tell it again about the felony drug conviction. I tell it to my classroom. Had a young lady come in, sat down, did her tax return. When we got to this point, she was emancipated, so she was out on her own. She was eligible for this credit because she was working while she was in school. And when she went to take this credit, we're going through everything. She had given me her 1098-T, and with her was her friend who had never said a word to me and was just on her cell phone, just whatever she was doing on her cell phone, didn't say a word. I got to the question I asked, have you ever been convicted for the felony or possessing of a controlled substance? The young lady I was doing the tax return for said no. Her friend, who had not said a word, had been on her phone, looked at her friend that was there doing the return and said, what about last year when you got pulled over and you were convicted for possession because of what was in the car? Well, obviously I had to say to the young lady, I cannot give you this credit because that would be a felony possession. And she took all of her materials and walked out. So I don't know if they're still friends or where she went, but I could not do the return because that was my due diligence, okay? As I said there, the American Opportunity Credit, you know, you get up to $2,500. $1,000 is refundable, and actually only the first 4,000 of education expenses on the federal qualify. So if you've got a child at Canisius, a private school, and you're paying $20,000 of tuition out of pocket, you actually only put $4,000 on the return form on the 8863 that we'll talk about, because that's how the credit is calculated. If you put anything over that, doesn't really matter. That $15,000 you can put as a full amount when we talk about the New York considerations, but on the federal, we can max out at $4,000, okay? Now, let me find one here. This is a little bit of lifetime learning. Here is a 1098-T, okay? Probably one of the worst tax documents out there. Somebody asked if they lie about that. If you've done your due diligence and you've asked them the question and they have that out there, the IRS will probably catch up to them because I would imagine they have something that they can cross-reference the database and they would get a letter. But, you know, at the time, you know, if you've done your due diligence, and like I said, with that young lady, I told her I cannot give you the credit because of this information. There's not a lot you can do if they do have a conviction there. Now, up here at the top, we have, whoops. This is the boxes that give taxpayers like myself fits, okay? Box 1 and 2 on the 1098-Ts. It is my understanding, starting with this tax year, that they are really cracking down on the institutions and the schools and the colleges and universities to get this right, okay? As you can see, box 1 talks about payments received, okay? More often than not, the school puts the information in box 2 that says amounts billed. That does me absolutely no good. I don't know if they paid it, okay? Because this is for qualified expenses that you've paid in the tax year. Just because they billed it doesn't mean it was paid, okay? And again, this is where the IRS and New York State like to send letters out and say, prove it, because that's where that amount was put in there. So, payments received, I want you to make sure that that's where that is. Now, if you see box 5 is circled, that circle is money that is not able to be claimed for the credit. So if I have $10,000 in box 1 and I have $4,000 in box 5, I have to subtract that out before I put it into the form. And again, we'll see that when we do a problem, okay? The other two important boxes are box 8 and 9 that are circled down there at the bottom. Those boxes indicate if the student is at least a half-time, and it also indicates if the student is a graduate student, okay? Now, personally, for my clients, and they've kind of gotten used to it, I like them to bring in the statement of student account. What that is, you go on to the student portal, you print out the little thing, it looks like a bank statement, it says X dollars billed and what it was for, then it shows how it was paid, that it has scholarship, mom and dad's visa, student loans, whatever. It is much more descriptive for me so that I can see that I get the correct credit and calculation there for them, okay? Because I see the gives and the takes, okay? Or credits and debits for those of you that are accountants, all right? But like I said, I cannot stress enough that if it says amount billed and that box 2 is filled in, it might have 2 and 5 filled, you make sure you ask the questions to understand whether or not they are qualifying for that as expenses paid in the year, okay? You have a little example here of a 1098T filled out for bill, okay? And then they have an example of the exercise. It shows on here the 8863 as far as the form and the calculation on it, okay? Oddly enough, most of the time when you do this form, believe it or not, you actually do part 3 before you do part 1 and 2, okay? All right? Because part 3 tells you if you should go to part 1 or part 2, all right? I don't know why the IRS does this, but as it says right here, complete a separate part 3 on page 2 for each student for whom you're claiming either credit before you complete parts 1 and 2, okay? Intuitively, I would think you'd want to put part 1, 2, and 3 in the right order, but again, on this form, the IRS says you have to do part 3 before you go to part 1 and 2, okay? And basically what this is it's getting the information in there, and then it has the little due diligence section in 23 through 26 where you ask the questions to make sure you have the right credit so that you can see at the bottom whether doing American Opportunity or Lifetime Learning, and then you go back to parts 1 and 2 to calculate the amount of credit that they would get, okay? Again, don't know why they do it that way, but that's just the way that the form was written, okay? As we can see here on line 50 of the 1040, that's where our education goes. In this case, they got the full credit. 1,500 of it is non-refundable, eating up part of our tax bill. And then we have the refundable 1,000 down here at the bottom to help get part of our refund, okay? In this case, they did owe, but you can see the credit is split between a refundable on, non-refundable on line 50 and refundable on 68, okay? Lifetime Learning, again, $2,000 per tax return for all eligible students, okay? A lot of limits that we talked about for the American Opportunity are not in place for this, so that we have a much more broader application of it. But again, expenses that qualify, different things like that, how it's paid, who's eligible for it, pretty much the same, okay? But there are some things that are not as stringent as far as the number of courses, no felony drug possession, that there's no, it's an unlimited number of tax years on things like that, okay? All right. What do you do if box 1 is not filled in? Good question. And like I said, for my clients, and most of the time, they can either, in this day and age of smartphones, they can contact their student and have them do a screenshot of their student portal or log in or whatever it is. go get that statement of student account. Find that statement. You know, like I said, to me, it's more valuable than any 1098-T that is out there. Okay. All right. Some more about the 1098-T. All right. And again, you'll have some chances here to do the calculations. Again, I want you just to realize that when we have you doing these forms, one of the big things that we're having you pay attention to is right here. Okay. Because basically you're doing some things that talk about who can take it, and some of it has to do with the phase out. When it says enter $180,000, well, we know that that's the case, that we're looking at a phase out for that refundable American Opportunity Credit. Okay? And when we look down here in the bottom on the lifetime learning, we see in there in the calculation that you're entering $132,000. So those are the case that those are entered because we wanted to understand that if their income is high enough that they may not receive this credit. It may be phased out. Okay. All right. Okay, we have the Boyd, so you'll be doing some exercises there. You can see on this one, they're probably asking you to do one of each. All right. And you can do one of each because one is for Olivia and one is for Thomas. Okay. Now, if both of these were for Olivia, then we're not going to be able to double dip on the credit. But in this case, we have Olivia as a dependent undergraduate, and we have Thomas, and we have him as a graduate. Okay. So we have two different individuals. That's why you do part 3 first, because you can see how many on the return. Okay. So there is an opportunity for you to have, well, bad choice of words. There is an instance for you to have the American Opportunity and the lifetime learning on the same return, but just not for the same individual. Okay. All right. Okay, so that gets us through chapter 6. And again, I made some notes about things we're going to come back to that we'll see when we have this. I'll talk more about some of these rules when we get into the actual tax returns there. Okay. All right, so that gets us through 6. Okay. We're going to take about 5 minutes. We'll come back and go through chapter 7, and then we'll do a couple problems at the end. Again, I sent some information out. If on the break you want to take a look, I did send out some problem answers as far as things from the workbook. If you want to take a look at the problems, I've tried to get through as many as I can when they all come in. There's, I think there's 20 of you that are doing the online. Not everybody's able to make Saturday morning. Some people watch it another time, but try to get through as much as I can when everybody's problems and homework come in. But if you want to take a look at your problems from the workbook that you've done from 1 through 5 and see if you have any answers, that would be great. Okay. All right. Okay, so we have the credits on that. Here's the credit for the elderly or disabled. Okay, again, a credit that is a non-refundable credit for any taxpayer who is either age 65 or older or retired on permanent disability and have taxable disability income. Pretty narrow factor on this one. You know, you don't see much of this because it does apply for a lower income situation. Okay, so but it is a credit. As you can see here, these are the income limits that we have on this. So that we have income limits that would base it on this with your adjusted gross income and non-taxable Social Security. And you can see even for married filing joint for this credit, if your adjusted gross income is above $20,000 married filing joint, and you're both 65 or 25,000, pretty limited on this credit. Okay, and you can see how that calculation would work. Okay, and again, we have a couple credits here that are the alternative motor vehicle credit. So not a lot with the credit there. You know, we just don't see a lot of this when you read these. You know, don't get the idea that that little electric golf cart, just because it has 4 wheels that you use to run around the neighborhood, is going to get you a credit. Okay, you know, a lot of these, the plug-in vehicle one, Actually, there's even limitations on the number of those credits available for that they will be able to turn those in. So there's a lot of restrictions on those. Tough thing about these credits for the vehicle credits, it becomes an industry that is really based with support on both sides. And what I mean by that is the government's giving money to a place like Tesla to do this, and it's also giving a credit to taxpayers. It's an industry, it's going to be interesting if one or the other is pulled out. Will you see as much activity on it? Okay? So again, talked about the retirement savings contribution credit, that credit up to $1,000 that you get for contributions to retirement. We have the child tax credit. Again, $1,000 per child. You know, that has the things for a qualifying child. Residential energy credit. Again, this is the credit of 9 lives that we have that is for solar panels, but it also is for things like furnaces, roofs, insulation, and the adoption credit. Okay. All right. Okay. So what we're going to do is we're going to do a couple problems here. All right. So we're going to go, and I'm going to get into my tax-wise. And timed out here. All right. And the first problem that I am going to do is I am going to do the exercise on 616, and that is the one for, I should say, out of the workbook on page 616. It is Bob and Julie Fowler is our clients here. Okay. And go ahead and get started with them in our tax return here. Okay. All right. Okay. All right. So we have Bob Fowler, and we have his wife Julie. Oops, this is my tab key. Hold on one second. And we have all right, and they are living at 5401 Royalton Center Road, and that is up in Middleport. We have an email for them for chocolate. We have, just going to put their cell number in here for right now. And we have their dates of birth, which are always important. Make sure you get those in there accurate, especially next class when we do talk about some retirement things. Okay. And Julie just had a birthday on Halloween. Okay, he is an IT manager, and she works as an office manager. Okay. They have decided to do married filing joint. They have no dependents on their return. They lived in New York all year long. You can see that we're going to e-file the return. The bullet point does say that they would like their refund deposited into their checking account. So we're going to go ahead and put that information in there. If they owe money, they said they would send a check. Okay, so this is going to go in just mainly for the fact if they do have a refund. And again, you know, we can't promise them a refund, but if they do have a refund, that they would have that in there. Okay. PIN numbers, like I said, I always use their zip code. And the reason for that, it has to be a 5-digit number. It's probably something they can remember. It's their electronic signature. And basically that PIN number is an extension of their Social Security number for their electronic signature. Okay. Okay. When you get into the actual office, you'll do the things with the driver's license and such. Whoops. Come on. All right. And like I said, always make sure you do the prepare information at the bottom. You can just kind of fill it in with any numbers that you want, but make sure you do that because due diligence will pop up on there, okay? A lot of the other stuff that shows up here will be stuff that will be defaulted in. All right, first bullet point for Bob and Julie filed a 1040A last year. Well, that tells me that they did not itemize because you cannot do that on a 1040A. So I'm going to go to my 1040 page 1, go into the middle. I'm going to check no for the box there. Okay, so we have that. One of the last things it says, second to last bullet point, it says the entire family had health care coverage. So we'll go ahead and take care of that on our ACA form. So they had health insurance all year long. It was not from the marketplace, so then they don't need an exemption. Okay. Now we're going to read through a few other things. They said we should use their information sheet that we did to complete the return. They were neither a full-time student or receive a distribution from a retirement plan. That talks about that saver's credit. No EIC was disallowed or reduced. Well, we don't have any qualifying children, so we probably won't have to worry about that. But then it does say Bob and Julie both have 4-year degrees and are taking classes towards their masters. Okay, so we're going to have some other information for them. All right. I have a couple W-2s. Like I said, navigation-wise, several ways that you can get the W-2, but I like to just use the tree on the left. All right. And we have that. So I have my W-2. First one I have is for Bob. He is the taxpayer. Address looks good. So we're going to check the box for his address. We're going to put the EIN number in there for the Computers Are Us. And most of that will populate for us. In your case, it won't because you're not linked to the database with the returns that you have there. We're going to put on here he had $48,289 for box 1 and $56.97 for taxes withheld. This little box sometimes lights up here where it says please verify the withholding. Basically it wants you to double check because it looks like it may be out of the parameters for somebody that would be filing a married return. Okay, now if you notice the W-2 there, box 1, 3, and 5 currently are all the same. Okay, but if you look at the W-2 on page 618 in your workbook, we have a D code for $3,500. Okay, that D code goes in there. All right, and it adjusts box 3 and 5 because this is pre-tax dollars. So it did that automatically for you because we know he actually made $51,000 that's going in for Social Security and Medicare, but because he gave tax-free money to his retirement plan, he gets to reduce his taxable income, which is box 1. Okay, the box in 14 for right now, I just want you to get rid of that. We'll talk about it next class with the 414 and things that for the 8880. He had an employer plan, okay, and his New York withholding we're going to put in there. Now, not going to put Julie's in yet because one thing I want you to notice, and it's a credit we talked about today. Married filing joint, their income, if we look at the blue box in the top left corner, is below $62,000. If you look on the tree on the left, okay, I have Form 8880. Okay, so I have that form, and that's the retirement credit. Okay, so if this was just based on Bob's income, all right, and I said no and no, because they are not full-time students. All right, they may be in grad school, but they are not full-time. They have taken no money out. That would be a $200 credit for their family based on the fact that they are not full-time students and did not take money out of any retirement the last 3 years. Okay, and that's because of just Bob's income. But for this problem, I am going to go back in here, and like I said, I like to use the tabs up here when I'm staying with the same form, and up above here I say copy W-2. It'll flash the screen. It gave me another W-2, and in this case, this one is for Julie, his wife, and we are going to put her in. She is the one. She is working at Donuts Unlimited. All right. Okay, and we have her income. And you can see now, if you look at the little tree on the left, when I put that in, that 8880 disappeared because now their married filing joint income became in excess of the $62,000 to qualify for that credit. However, she is still contributing to her retirement. And again, these are pre-tax dollars. So we can see that it adjusted box 3 and 5 based on that. Okay, we have a retirement plan. Again, box 14, I'm going to get rid of all that information. And I'm going to go down and put their state withholding in. All right, okay. So we have that. So we got their W-2s in. All right, now I want you to notice their box up there on the left. Okay, refund thing, looks like they're kind of trying to break even. They owe the federal government $1,745, and they got the state $1,135. All right. Now, they did both go to school. So if you look at 619, we have some education credits. Navigation-wise, I'm going to take you this way. I'm going to go to my 1040 page 2, and they have some education credits. Okay. So I'm going to light up the box. I'm going to hit F9. I go in there and look at the education credit. And the computer's smart enough, it takes you right to part 3. Okay? All right, so page 2, part 3. So I am going to put the information in. The first one is for Julie. Oops, missed my tab key again. Julie Fowler, going to put her social in there. All right, she went to University of your state. Okay, and that is on 159 Learning Lane. All right, and that is, we're going to say that's in Amherst. All right, we got a 1098-T for her. We did not have anything on this one. Okay, all right. Okay, and we're going to put the EIN number for the university in. Okay, so we've done that. Now, next part we're going to do is kind of our due diligence. As it said in the bullet point, both Julie and Bob have 4-year degrees. So they've claimed this before. So we're going to hit yes. And what that does is basically tells us you got to go right to line 31. Well, that one's in red. And for Julie, I have $3,300 of tuition credit. Okay? All right. And if you look, it now made page 1 with parts 1 and 2. So on my tree on the left, I went to the 8863. You can see it calculated that non-refundable credit of $660. Okay? But I'm going to go back to Julie's page there, and I have that. So I went to my 8863 page 2, but I got to put another one of those in because this time I have one for Mr. Fowler, Bob. Okay? So I'm going to put a second one in. All right, and they both went to the same. They must commute together. All right. And again, on the same 159 Learning Lane. All right. Okay. And we talked about the questions there. Get the EIN number in there for the school. All right. And again, same thing, but I'm going to do things a little bit different on this one, okay? So what I'm going to do is say that Bob has only gone for 2 years for his associate degree, okay? So we're going to put that in there. He's only got 2 years, hasn't used all 4. We're going to say that he was enrolled at least half-time. All right. He has not completed 4 years of post-secondary education, and he's never been convicted for the possession or distribution of a controlled substance. Now, for him, I have the opportunity for the American Opportunity Credit. But if I look at box 1, it says $4,800 in his form, his 1098-T. As you can see, I cannot enter more than $4,000 for him. Okay, so I'll put that in. All right, and he's got a nice credit there. Now that is an instance where I can take both credits because they are different students. All right, if you notice too, for a New York State consideration, this pops up. It's the IT 272. This is the credit for the college on the state side. I did do an 8863. These students are on the returns, so we can do yes and yes. Okay, and were these students for undergraduate? Well, Julie, we remember, is no. But Bob is yes, because they were for his first 4 years for his undergraduate degree. So we can put all 4,800 in there for him. Okay, so he has the ability for the credit. Now, I go to the New York 272, page 2, using my tree on the left. You can see I got a little $200 credit. Okay, all right. So I have that. Now, down here in 8, we're going to make a comparison. Sometimes for tuition, if it's very high, it's better to take it itemized. Okay? In this case, not a good idea because I lose $200 on my refund. So I'm going to use it as a credit. Okay? So that's the way we would do that. Now, I'm going to go back to Bob's. I'm going to change him back the way his return was supposed to be done. Okay, so I have to take the 4,000 out of there, and I put the 4,800 in here. Okay, all right, so if I look, my education credit, I got $1,620. Remember, maximum $2,000 per return. Okay, so that helped out a little bit. They're about break even on the federal, so they owe the federal $114. I could go to fix my state because this was no. All right, so we lose the credit on the state because they were both for graduate school. You only get the credit on the state for undergrad. Okay, so we have that problem in there for them. All right, so that's kind of how the education credits work and how those work on the different things. There is one problem I am going to assign you. I'm just looking at my notes here. Going to give you the one, you get to go back and do a worksheet for dependency. So I'll have that one be assigned to you. Okay. All right. In chapter 7, we are going to do the problem 7-2 for Mr. Greg Fellows. Okay, so we're going to do 7-2 for Mr. Greg Fellows. All right. So we're going to do that for him. So let me get him in here and get him started. If you want to read the bullet points, it's on 7-8 in your workbook. So we'll get him in there. Well, okay. All right, so we have Mr. Fellows. Bullet points while this is loading up. 1040A last year, so it tells us he did not have a itemized. Everything's going to be done electronically. It uses information. Never had the EIC disallowed. He is the custodial parent of Greg Jr., and he did replace his furnace. Okay, so we have Greg, and he has a middle initial of M, and Fellows. All right, and he is living on 11694, looks like Shannon Drive, and that is in Merla. Okay, we'll just put his cell phone in here. And again, you know, this is part that gets a little repetitive, but, you know, again, so very important. We talked about it at the outset when we were talking about the headers and the main info. You got to get everything in here right, because it's going to talk about how his return basically works from what you do. So once we get that in there, we got to take a look at his main info. Greg, as it says there, is a custodial parent of Greg Jr., so the child lives with him. So that makes him head of household. Okay, we have him as head of household on there, and we're going to put in Greg Jr. All right, his date of birth is 1/16/2006. Okay, so as soon as that goes up, age 11, light should go off and says, I wonder if he has child care or dependent care expenses. Okay, so we have that on there. Lived with him because he's the custodial parent. All right, here's the column for the DC. We have dependent care. He talks about, yes, I do. My child goes to wilderness daycare. Seeing that he's a logger, they must live somewhere in the woods. The other thing is, I want you always to get in the habit of checking that EIC, that earned income credit. Okay? Once I check that DC box, if you notice on your left on your tree, there is a form, the 2441 that we've talked about, that was populated on there. Okay? New York resident. As he said there, he wants everything deposited directly into his bank account. Okay. All right, so we have everything in there. We talked about the fact that he had a 1040A last year, so he did not itemize. And the last bullet states that Greg had coverage, and he also covered his son. And it was not through the marketplace, so we got their insurance coverage checked. Okay? All right, so we're going to go take a look. First thing we're going to get in there is the W-2. And I have him working for Logging Town, USA. Okay, so we're going to get that in there. We're going to put in his wages. Now, when I see his wages, and I know he's head of household, first thing that should go off is, I wonder if he's going to qualify for the earned income credit, which he does. So that is a refundable credit that we have for that. Okay. We have nothing on retirement 12, and nothing in box 14 on this one. We have some state withholding. Okay, so we have everything in there for his W-2. All right. Okay, the other document we have is child care. Well, remember I said take a look at box 10 still on the W-2 here. Nothing in the dependent care benefits. We're going to go to his 2441. This is where we're going to put in our child care. Okay. I'm going to put in Wilderness Daycare. And their address is on 98 Wild Street. Doesn't sound very comforting for the kids, but all right. We have in Amherst, we have their EIN number. Okay. And he paid $2,100 in child care. Okay. So I put that in. As you can see down here in part 2, it's asking me qualified expenses. All right. Qualifying expenses are those you incurred, and in bold letters says paid in 2017. So I can only put those in there. All right. So I put that in there. And based on his income, we have his little factor there that we saw. So he gets a nice little credit of $211 on the federal. We'll see some on the state. And if we go to New York 201, page 4, he gets an additional, okay, $739 on the state side. So with income being a little lower, and if somebody's working or looking for a job and paying child care, you know, it can be a nice little credit. So in this case, they were paying $2,100, and between the two, you know, he got well over $900. Okay. Last thing we have is a bullet point that says Greg replaced his furnace at a cost of $2,735. Okay, well, we know, and again, I like to use the 1040 as my navigation point. That's where I go back to. I have my residential energy credit here on line 53, the non-refundable credits that we talked about. Okay, we are going to put that in. All right, and we have the residential energy credit. And on this first page, and we'll come back to that in a second. First page of this talks about solar panels. I'm going to kind of get back to Jim's question he had about the state in a second here. But the credit that we're talking about with the furnace, whoops, missed there. The one with the furnace is actually on the second, is part 2, okay? So I have, and, okay, and this was made to his house on 11694, and that was Shannon Drive. And again, we talked about his address. And this was not construction of the home. Okay. All right. So if we go down through here, you can see there's all these categories about, you know, the exterior doors, the insulation, metal or asphalt roof that meet or exceeds Energy Star, windows and skylights, and all those things down here. Down at the bottom, we have a thing here that talks about qualified natural gas, propane, or oil furnace or hot water. Do not enter more than $150. So in this case, $27.35, but I can get him the credit of $150. Oops. Okay. All right. So we have that in there. All right. So that's the way this problem would be done as if it was. Okay. Just going to show you a couple things. I left some things here. These are all due diligence, and just for time, those are things I'll have you read through. There's a question here about no disallowance of the child credit. We have our little worksheet for the earned income credit. And then, like I said, when you're making sure that you put your preparer information in, this paid preparer's due diligence, just want you to kind of read through those questions. Okay. Now, if I go over here, if I take a look, his income, he only had a $211 credit. Okay. So with that credit on there, okay, when with that credit on there, you can see that all he really used was a small portion of the child care credit. Okay, energy credit doesn't even show up because he didn't need it. Okay, so when I look at that $56.95, it's not even used, And if I look at his credit here, okay, he could have actually had a credit of $672, but it was limited by the 211 that is his tax liability. So that's, again, where I talk about those refundable credits really being pretty limited. He was eligible for 2 credits that would have been pretty sizable, but because they're non-refundable, most of his credit is coming from the earned income credit, his tax withheld, and the additional child tax credit, because the child tax credit was not used up above. Okay? Now, on the energy credit, seeing that they live out in the woods, all right, we have decided that he is going to buy $5,000. Oops. $5,000 worth of solar panels. Okay, so there's that 30%. All right, so he has that. But as we remember, they sold him on the fact that, wow, you could get a credit for $1,500. And Greg said, sure, it sounds good, but that it's not there. Okay. If I go over to the state side, I don't see it there either. Okay. We have the child credit on the state side. We have the earned income credit and dependent care credit. Okay. All right. Now, okay, if you go to, let's see, we want to take some of this back out. Give me 1 second here. Got to make some modifications. On that. Okay. All right, so we have the credit on there for the federal. Okay. All right. And we'll clean up the state a little bit here. They live in, let's see here, we had, let's see, Greg's in Erie County. And actually, he's in the Iroquois School District. And that code for Iroquois is 300 from the little chart that I gave out to you. And did not have anything on the credits on that. And his refund, he wants deposited into the same account. All right, so just kind of some of those cleaned up a little bit, okay? All right, so that's how that energy credit works. Okay, so we have all of the credits that we had on there. You can see on the state side, he has the dependent care. And as you notice on these, a lot of these credits that we may see disallowed on the federal are refundable on the state. Okay, all right. Okay, any questions on that one? Any questions on any of the other credits that we had? Yeah, Pat, do them anyway. I use the example of that, the solar credits. Let's see, on the first one, credits, sorry, graduate school. So, yep, that's, you know, again, their graduate school, the IT 272 wouldn't even have populated for them. But if you had one in undergrad, then you want to do that form for them just so that you show that they can get that credit on the state side for any undergrad. Empire State Credit is automatically applied, yes. You know, that's a credit that Empire State Child Tax Credit is automatically in there because it is refundable on the state side. Is this the last year for 67? Nope, that's been around. I don't believe that it's disappearing. The real property tax credit, if you're talking about the state, I would assume that's for the state. Okay. All right. So yeah, this is not the last year for it on that one. Okay, any other questions? Anything about stuff we've covered today? Okay. Oh, I forgot what I forgot to do. Okay, hold on one second here. Jim had asked me about the other question. Okay, the energy, the solar credit, and there's a form that's called. I found it. It doesn't really populate. It's not. Doesn't jump out to you on the New York 201, but we have our solar energy systems credit. Come on. Okay, so this is a credit we got here, the 2555. And does a solar energy system use solar radiation to produce energy for heating, cooling, hot water, etc.? Yes, it does. Okay. He purchased it. Let's see, we're in 2017. We're going to say that he bought it today in 2017. Okay. He spent $5,000 on it, as we talked about on the federal. Okay. All right. So we have that. You can see the calculation there. All right. So we have all that with everything that he purchased on there. So he has a nice little credit available of $1,250 and with the carryover to next year. Okay. Well, let's go find out where that credit went. Well, first thing we got to do is it created this form here for us, the New York 201. We can see our solar energy credit here. You do have to answer this question. I guess this is pertinent to New York. That have you been convicted for bribery involving public servants or corrupting the government? It must be something that they're very worried about in New York. Okay, so we clean that up and we go to take a look at our form here. We don't see it. Okay, we take a look at this here. Here it is. It kind of hides on line 42, the non-refundable credits. Okay. We were able to use it, plus this little household credit, to wipe out our tax bill. It is not a refundable credit in New York, but it is like the adoption credit on the federal, where if you look, we have a carryover to next year. So this credit would carry over to the next year. Okay. So we would be able to benefit from that. All right. Sorry, I almost forgot about you, Jim. Looking at my notes here. Greg is very concerned about his son going to college. All right. So if you look here, we have some additions and we have some subtractions. If you look down here, if I make a contribution up to $15,000, so he's going to put $1,000 in a 529. That's going to lower his taxable income. But again, in this situation, because we wiped out the credit with the solar and stuff, doesn't really help us on that. Okay. All right. Now, to make this problem interesting, instead of Greg being the custodial parent, okay, he is going to be the non-custodial. So he cannot be head of household because he does not have a qualifying child. So we are going to make him single because he cannot be head of household with Greg on there, okay? And, well, I take that back. We're going to keep him at a household, but he has agreed with his ex-wife that she can claim the child for the exemption child. So he's passing the dependency on her. He's still had a household, but what he's giving up is his claim to the child credit. Okay, because you can see the box, the child credit got unchecked. Okay, so that's how you would handle that if it's the case that the EIC. He's living in the house for 12 months, but he is not a dependent on the return. So he can still do the things that he has there. Okay, all right. Cheryl said, looks so easy. When you've done 1,500 returns a tax year, sometimes you get, and I apologize if I go too fast. Sometimes you just get in that rut where you're used to doing them. But, you know, I try to explain my thought process on each of them best I can, okay? So we have that on there. Foreign earned income, okay? Let's see, how do we want to do this one? The foreign tax credit. Okay, so he had a little investment. And he told me he had a foreign tax credit. Right here, the non-refundable credits, you can put it right on there, okay? If they have foreign tax, you go into this form, and it's actually 4 pages long, and there's a bunch of stuff to do about the country that they were in, taxable loss stuff. But if you look up here, simplified limitation election, if it's less than 300 for this case for a single or whatever, but you have a little $10 foreign tax credit, I can just put it in there. I don't have to use all of this form and pull things off the other tax return from a foreign country, okay? And like I said, that's probably a little advanced for right now, so we'll kind of leave that alone, but I just want you to know that he can use that foreign tax credit. So we have the $10 there is dependent, the next one. So if you think about it, these credits are kind of in pecking order. So which one's going to be used first? These two, the education and the child tax credit, have a refundable portion, so they're going to go below. And the adoption credit, if it were here, would carry forward to the next year. Okay? So sometimes they're in pecking order about how we're going to use them to eat up our tax bill. All right? Okay. All right, so that is everything off of those. Okay. So we have everything in there. So we did a couple problems. Like I said, fundable credits, Energizer Bunny, non-refundable credits, Pac-Man, they stop. They have a little bit of pecking order, as we can see here, that which ones are used first. And in this case, because the child tax credit, well, I should say child tax credit's gone because he gave that away to his ex-wife. So it's gone down here, but it would show up there. So if we went back, we'll put them back in there. Okay. And you can see that that credit, because I didn't use it up above, got passed down below. So non-refundable, kind of a pecking order there. All right. Okay. Any other questions on anything? Okay. I know we went through quite a bit of stuff with all the things. Like I said, this will all be recorded on there. All right. All right. Any other questions from anybody? All right. Like I said, I did record this, so you will have a recording of it. You know, if there's content that you want to focus on a little bit more, there's specific recordings of each chapter from the classroom that you can take a look at there. But for right now, we have everybody there. Any other questions? Or anybody can pop the microphone off and let me know if they have any other questions on anything. Okay. All right. Okay, so I will send the recording out on this. Hopefully I don't have any snafus this time. With getting the recording, it took a little bit last time because there were some transition errors to make it viewable on YouTube, but I'll have that. What I will do is send out the homework and the link for what I want you to do out of chapter 6 and 7 on those. I've already given you problems. What I will do this week is just so that when we get to lecture time on Saturday, that you can kind of say, hey, I didn't get that. What did I do wrong? What I will do is send out the problem answers for 6 and 7. I'll send those out on Friday as kind of a reminder. So I'll make sure that you get those on Friday, that you can take a look at your problems you've done through the week, so that you can say to me, I got this, I didn't get this, or whatever it may be. Okay. All right. And any other questions? Again, if you want to turn the mic off in the lower left, you can. Or you can type in the chat, and I'll give everybody a second because I know everybody's not as fast as a typer as some. Okay. All right. And also let me know, everybody that here or listens to this later, let me know as far as the additional emails that you got those okay. I know one time at one point somebody typed in there to make sure to check in your spam. I don't know why the EGTax or egtax.com tends to go into that spam at times, but it does. So, okay. All right. Okay. Well, seeing that we have nothing here, everybody enjoy the rest of the day. I'm sure that you got plenty of time to do taxes today because it's too wet to rake these, and I would not want to be in the gutters. And plus, you get to change your clocks tonight. You got a whole extra hour of time to do taxes that's not going to cost you any part of your day. So you got extra time to study, okay? All right, well, everybody enjoy the rest of the day. And again, if you have any questions, text me. Keep sending the emails in with the homework. Like I said, I may or may not respond. Sometimes some things jump out at me. I may touch base with somebody, but everybody's been looking like they're doing great. And we'll see everybody next Saturday.
Thank you.